other product that's Good afternoon. I'm Josh Barro. I'm a contributing opinion writer for the New York Times, and I host the podcast Central Air. And we're here today to talk about threats to democratic institutions and how that may affect the economy. We used to hear a lot about the corrosive effect of uncertainty on business investment and growth. And in fact, we used to hear a lot about that from Republicans. But the Trump administration has seemed eager to generate uncertainty at a lot of times, make it more difficult for businesses to figure out what policies they're going to be subjected to, and therefore more difficult to figure out what investments can make money. And so today we're going to try to scope this problem. We're going to talk about what are the erosions of institutions that we're seeing with economic relevance, how much damage we can expect to them or are already seeing from them, and how much damage we can expect that to cause in the economy and where, how to measure that, and finally, what we might be able to do to fix it. I have a great panel here with me today to talk about that. Cristina Rodríguez is Deputy Dean and Leighton Surbeck Professor of Law here at Yale Law School. Martha Gimbel is Executive Director of the Budget Lab, also here at Yale. And Eric Van Nostrand is former Assistant Secretary of the Treasury for Economic Policy in the Biden administration, and also Global Head of Markets and Chief Economist at Lazard. So, Cristina, I guess, there's so many different aspects of this that we can talk about. What are when we talk about democratic institutions being undermined, which ones specifically are we looking at?
So that is a big question. And one of the things that's especially interesting about this panel is you could come up with a long list of democratic norms and institutions, I would say general rule of law concepts that are under pressure. But which are the ones that create the sorts of instability that might have an effect on the economy is a separate question. Right. So there are a few that jump out to me as important to this conversation, but I think it's critical for those with economic expertise to explain whether that's in fact true. First is the manipulation of law enforcement into the use of the controlled Department of Justice to go after political foes, to fire prosecutors who will not bring prosecutions when they don't think there's sufficient evidence, and the pardoning by the president of people who've committed financial crimes or other kinds of crimes that align with his agenda. And I think this cuts at the stability idea that you started out directly, because it creates a non-reliable system of law enforcement. So if you don't have a system of law enforcement that's based on evidence and based on commitment to enforcing the law, but is instead based on personal whim, then you potentially generate instability. I think that related to that is the rise of extreme self-dealing by the president and the scope of the corruption that we're seeing under this administration, which to me is along with the manipulation of law enforcement, seems to be turning at least the federal apparatus of government into a system that promotes cronyism as opposed to sound decision-making, as opposed to a commitment to law enforcement, as opposed to evidence-based decision-making. But again, whether that ultimately has an effect on markets is a different question, or on the economy more generally. And then there are a number of other things we could list here, but the last thing I would say, just as by way of introduction, a lot of what's happening in the world of financial regulation looks a lot like what you would expect a normal Republican administration to do. So lots of regulatory efforts, decisions not to go after crypto under whatever law enforcement authorities exist, pulling back on SEC enforcement actions in certain domains like crypto, but also eliminating disclosure obligations on issues like climate impact. But there are also things that are happening in this sector that are suggestive of systemic instability, like threatening to fire the Fed chair. I mean, that's a big one that gets talked about a lot in the media, and then the attempt to fire Lisa Cook from the Board of Governors. Will that in fact have the kind of effect that administrative law scholars and people in the financial world have long predicted would arise if it looked like suddenly the president was going to start interfering with this very spine of our financial system? And so that set of issues, while not obviously an attack on the rule of law, might ultimately be the set of issues that's most relevant. this conversation.
Well, I mean, some of that is an attack on the rule of law, right? I mean, there are statutory limitations on, that you're supposed to, you can only fire someone for cause. Maybe that you can interpret cause so flexibly that the president's choices are unreviewable, but certainly not intended for this sort of situation.
That's right, except that I would say that the legal basis for those for-cause protections has been eroding under the Supreme Court. And so I see that as norm busting and setting up for the Supreme Court the opportunity to do what it has wanted to do for a long time, and less an assault on the fundamentals of our system that some of these other moves, like the politicization of law enforcement or the corruption, suggest.
Martha, is that covering most of the issues that are keeping you up at night, or do you have items to add to the list?
I actually think about it a little bit differently. Corruption is actually weirdly not one that is as high for me, despite the fact that corruption is a growth killer. When I was at the Joint Economic Committee, I did some back of the envelope calculations about like how much of the US's growth since the 1940s was about the fact that we do better on corruption relative to Italy. And I never published those because it was so big that I just thought that no one would find it plausible. So, yes, corruption is a growth killer. It's not the thing that sort of I worry about the most. I think I'm sort of less worried about a differential law enforcement. I think as long as you have, things like bankruptcy courts and things like that are still functioning, that industry kind of needs, I think to me, I'm sort of less concerned. I do worry about the Fed, and it's been interesting to me that markets do not seem as worried about the Fed as I am, which I would love to hear from Eric on. I also just worry about, for lack of a better phrasing, sort of the atmosphere around investing in the United States. The United States is considered to be a really safe place to invest. We benefit from this in a ton of different ways. If the United States is perceived to be riskier, then our cost to borrow, for instance, goes up. We've sort of benefited from the fact that at this exact moment, there's a little bit of a like, what else are you going to do? Right? You can try to move your money to Switzerland, but there's only so much money that Switzerland can absorb, right? It's relatively small. And so there aren't that many like large countries issuing a lot of debt that are appealing where people can send money. And so like other people are kind of stuck with us at this point, but it's all relative. And so if other places start becoming more attractive, you can see sort of an erosion. So that's a little bit more where I am. It's kind of like, how risky are we relative to other countries? And then I do really worry.
So we have a number of risk areas there, some of which strike me as things that should be easier to measure in the financial markets than others. I want to get to the Fed in a second, but I want to start with the corruption issue. Because, it's, as Martha notes regarding her unpublished research, I mean, it seems like this should be a really large driver of economic outcomes. I mean, we get a lot of comparisons lately of the US and our politics and our, business regulation to Argentina. And when you have countries where success in business is heavily reliant on, do you have the favor of the president? Has the government decided to smile upon your company? That's supposed to make the corporate sector less profitable. It's supposed to make it harder to make profitable investments, both because investments get directed to things that are not, fundamentally good investments, or because it's hard to figure out ahead of time which ones are going to be smiled upon by the government. So shouldn't that mean that the net present value of future corporate profits has declined because of this stuff, and the stock prices should have gone down? But I mean, obviously we're having quite a good year on the stock market.
Yeah. Let me tell you a trick economist pull, which Martha just pulled, which is a couple of years after the fact, they cite unpublished research. But I'm going to do the same thing now. I just want everyone to be clear that he did it first. Here's how I think about the market response to all of this from kind of a general matter, and then I'll zone in on the personal aspects of it too. I think there are a couple of factors that I'm kind of the big question about why do markets appear to be looking through all this in general. I think there are a couple of answers that are just making it harder to see. But my bottom line here is that markets do care about this and markets are reacting. But at this point, they're reacting in a kind of under the hood way that you have to be a real finance geek to squint and see. But when the finance geeks squint, they do see it, and it has a real risk of spreading to more obvious indicators, I think, in the months to come. I think there's probably three main explanations for the relative calm of markets in the face of all this. The first is what, markets people are calling the taco trade, Trump always chickens out, which is that basically they don't believe, there is a popular belief in the investment community that most of the rhetoric here won't manifest, that Trump won't actually follow through with a lot of these activities in particular. That's one thing. The other main thing is that what markets are truly consumed with this year is the AI boom. And the intense focus on AI has made it harder in headline indices to really see what's going on. And the third thing, I know, Josh, you said you'll get to the Fed, but I think it's really important. The particular nature of the threats to the Fed's independence here, while I think we'd agree they're bad for democratic norms, I would argue, and I think most of us would agree they're bad for the economy in general. They're actually, and for a rather perverse reason, good for markets right now, which is that what markets expect to happen with the Fed is they expect the Fed to permit structurally lower interest rates than the macroeconomic backdrop would otherwise justify. And while that creates a lot of risk down the line, especially inflation, it frankly juices stock prices right now because it says the future cash flows of these companies are worth more today. And all of those three things are kind of, I think, hiding the real ball. If you look, and happy to go into some of the wonkier things, if you look at what people expect what people expect long-term interest rates to be in the long run, a forward rate, those have stayed really oddly elevated relative to the macro backdrop in a way that I think reflects uncertainty about those sorts of things. If you look at insurance buying against big downside economic catastrophe in the coming years, that has gotten really expensive. Investors need to pay up for downside protection, even though on a headline basis things look okay because of AI. So if you look under the hood, there's worries here, but it hasn't manifested because of a coincidental other things.
Wait, Eric, can I do Josh's job and now
Go
ask
ahead.
you a question?
Sure.
Which is, can you talk a little bit about how markets just in general think about inflation risk? Because if I think about the things that really keep me at night at like 1 a.m., it's that you see a resurgence in inflation. I worry that this administration doesn't seem particularly concerned about tamping inflation expectations down, which is part of how you prevent a resurgence in inflation. And that the Fed is in a situation where like they can't respond, right? Like that's the thing that really stresses me out. And I'm just wondering in general, not even specific to now, but like just how markets think about inflationary environments and what that means for returns.
Sure, yeah, and I think it's very relevant to this conversation because I think the big downside risk of the Fed threats is that, and this is very kind of standard textbook first year macroeconomics, is, the reason the academic literature extols the virtues of an independent central bank, even though it can from time to time seem a little bit undemocratic, is that there are rarely political incentives in democratic systems where everyone's incentive is measured in a few years electoral cycle to keep long-term inflation risks under control. And an independent central bank can do that. And what we're seeing here is a central bank that seems to face a near-term political incentive, continue juicing stock markets and economic growth and hiring and other things that we generally think are good in the near term, but to do it at the expense of long-term inflation risk. The way an observer of markets would normally assess those risks is by looking at long-term interest rates, which if you cut them a certain way can tell you that investors are expecting more inflation. And one of the challenges about this episode is that the standard interest rate measures you would look at for that actually seemed relatively well contained. 10-year US Treasury interest rate went up a lot earlier this year. It's come back down a lot over the past couple of months, and that's pushed this narrative that everything's fine with respect to inflation. Again, I think that has largely other drivers. One of them Martha mentioned, which is that there aren't a lot of global alternatives for people to put their money other than US Treasuries, and that pushes the interest rates down. But it's obscuring the fact that inflation risks are, I think, obviously higher today than they were 6 months ago. If you look not at markets, but at surveys of flesh and blood economists and ask them what they think, and forget economists. Actually.
Is that right?
Yeah, well, it's actually, I don't think economists are predictive.
Okay.
This is against my interest to say,
Yeah.
but there are also business leader surveys of what they expect for inflation. and household surveys. They're all always wrong on an absolute sense. They always expect much more inflation than ever shows up. But directionally, when those groups change their expectation, when they show that there's a kink upward, that I think is predictive of activity because because it does chill a lot of investment activity.
There's a couple of different sources of threat to Fed independence. And I guess first I actually wanted to ask an annoying question about terminology, which is like, this is supposed to be a session on democratic institutions and threats to them. The Fed is not really a democratic institution, right? Like, in fact, the things that might happen to the Fed would make it more democratic.
Well, it depends on how you define democracy.
Okay.
And I would describe it as a democratic institution because it's an institution created by Congress with a certain structure in order to serve a particular purpose. And the independence of the chair and the board of governors is essential to the purpose it's supposed to serve. And that was a choice made by the Democratic legislature to structure it that way, which is why I and others have probably the Supreme Court is doing to that concept of independence. That is undemocratic. And so in the name of allowing presidential control over the institution, they're actually potentially destroying something that as a system, as part of a system, we've determined, meaning Congress has determined is necessary for our economic well-being.
What do you make of what the court has been doing specifically with regard to the Fed, where there's the court has broadly been undermining any of these independent agency structures? And then there's been this hand-wavy stuff about the Fed is different and historic and special.
Yeah.
Is that and then they acted differently in the Lisa Cook cases than in some of the other cases where they
yes. And so I think what that demonstrates is their awareness of the role that the independence of the Fed plays and the overall economic structure. I think there are two questions that come out of that. That one is whether they can ultimately sustain the distinction that they've drawn between the Fed and other independent agencies, and the explanation is actually not consistent really with what the Fed is. It feels like jerry-rigged for this purpose. But the second is, and this goes to the bigger question about what the style of this administration is injecting into the way people perceive the United States, the way things operate, is just the making of the threats and the persistence of the threats eroding confidence. And I think it is quite possible that the politics of that is maybe almost as damaging as a decision to fire someone in the Supreme Court backing it up. And it seems like confidence that the system will function the way it's supposed to, as opposed to in response to political whims, matters to investment. It matters to consumer confidence. It matters to the economy more generally. So that's something we should all worry about.
And so what is one, if we assume that the Supreme Court will ultimately not, completely abrogate Fed independence, they will come up with whatever nonsense thing they have to say about why the Fed is special and unique. What do we do to rebuild that confidence in Fed independence over the long run? Like what is it for, members of the US Senate, for people working in the next presidential administration? If you want people to feel again that the Fed is going to, follow its dual mandate and not try to juice short-term, economic growth when it's inappropriate, what do you do to put that toothpaste back in the tube?
Yeah, that's hard. I mean, in many aspects of life, not just monetary policy, there is a maxim that credibility is hard earned and quickly lost, right? And over the past, the way that Fed credibility has evolved and strengthened over the past 30, 40 years is, I think, one of the great triumphs of Western economic policy. The impact, the stability and the reduction in the variance in economic growth and inflation that we've seen over the past 30, 40 years is, in my view, mostly attributable to the way that Fed communication has managed to gradually, carefully build that credibility up over the past couple of decades. And it will be very difficult to do that again. I also think it's about more than just, not to minimize the importance of the Supreme Court cases, but even if the court doesn't intervene in a way that it undermines what we think of as Fed independence. In May, there will be a new chair that will be appointed by the administration and likely confirmed, who will probably think about that independence in a very different way. And that alone is, in my mind, sufficient to change the way markets think of it. I hate to say it, but I think that, the actual forcing mechanism that would get Congress, for example, or a future administration of either party to, start talking about the Fed differently, to kind of try to put that toothpaste back in, you would need a rather painful forcing mechanism. You would need something that feels much more like a market crisis in terms of bond yields, in terms of long-term interest rates than we've had so far. That's long-term interest rates are the thing to watch, because that's where, when markets say, whoa, the Fed has lost control over inflation in the long run, that's what will kick out quickest. And we saw that start to happen earlier this year. It just got mitigated very quickly when the whole world shifted to AI.
That's bad news for the 50-year mortgage, Eric. That's gonna really.
So in the nearer term, like the Senate is one of the, is one of the constraining institutions here. And we've seen some willingness on the part, even with a Republican majority. I mean, for example, they were unwilling to confirm E.J. Anthony to run the Bureau of Labor Statistics after the president's termination of the prior director of that. Is it a matter of the Senate just making sure that the Fed board appointees are less crazy?
I mean, it would be great if the Senate took a role here. It is very unclear to me, and I have not been able to get clarity from the people I've talked to, I don't know if others have heard, how much of E.J. Anthony not having the votes was about the fact that, in my personal opinion, he was a threat to the independence of the Bureau of Labor Statistics, which is important. And how much was about the fact that he had done interviews with a Nazi battleship behind him, right? Like there's a, how much of, I don't know. And so as far as I'm aware, there are not candidates that were being talked about that have that same level of personal baggage for the Fed. And so I guess we're gonna find out how much the Senate may care about policy independence and substance as opposed to Nazi battleships.
Let's look at some of these other areas of threat. I want to go back and actually talk about the manipulation of law enforcement and the politically motivated prosecutions. I mean, you can imagine one way that investors might think about this, and I think often are thinking about it at this point, which is that this is, a specific set of stuff that has to do with Donald Trump's grievances related to the 2020 election and various things, and it does not appear to have that much to do with business investments. I guess, first of all, is that a mistake if they're taking that view? And then what would we be looking for as, something that would say, no, this is not only a threat to our rule of law, it is also a threat to the value of business investments?
I haven't really answered to the question of whether that's an actual threat, but the question I would have that arises from that is, to what extent is it important that the courts and the systems of law enforcement be reliable and predictable and based in evidence and reality, as opposed to being in the service of the chief prosecutor, which in this case is the president? Because in accounts of development, having a functioning legal system that operates according to rule of law norms creates a kind of predictability that is necessary to give people confidence to invest. And you said before, Eric, something about there's no other place to go but US Treasuries, right? How long will that be true, right? How long can the United States maintain the confidence that, because it's a long-standing system, it's not a system that's trying to develop its way out of a different regime. It's a system in decline, but it has a degree of dominance, and the stickiness of the institutions might mean that even if there is this happening at the surface level, that we can have confidence in the deep structure. But you need that deep structure, I would think, in order to maintain order to maintain that dominance.
Martha, is there somewhere you're looking in the courts in terms of where the threats would be?
I mean, I do think you would need to see things that are really about, for instance, how bankruptcy courts operate and things like that. I realize that I'm the person who brought up the Nazi battleship earlier. I don't mean for this to become full reductio ad Hitlerum. But one thing I think that's important to keep in mind is, if you think about the Nazi legal regime that's put in place, we often talk about that as well, we say lawless, but they had their laws. They were, if you were, for instance, Jewish, obviously there was not like a process that worked for you. But there were parallel court systems, right? And so for many business leaders in Nazi Germany, the court system continued to work fine, right? They were able to do their business and feel like they had law that they could follow. And that was a thing that the regime went out of their way to make sure happened because they knew that it was important. And so, I do think it's very easy to say like, oh my gosh, rule of law, X thing has happened. But I think it's important to distinguish between, as Josh said, this kind of rule of law questions about targeting enemies as opposed to what business relies on to make things work. Now, I would say that creates a problem because then you're trying not to get on the enemies list. But from like a day-to-day perspective, those are sort of different questions.
But how would you couple that with the turn towards non-enforcement? So non-enforcement of financial regulations, which again is a systemic issue, and businesses might like it. I saw something from the Chamber of Commerce, like this is great, right? But it does mean that the laws that are put into place that are designed to keep the financial systems healthy are not playing the role that they're supposed to. But maybe that doesn't matter.
I mean, it's sort of a question for Eric, but I will say one, in general, business is in favor of business-friendly regulatory and legal regimes. And also, I don't think if the theory, right, is that there are then, more risks percolating in the system that could at some point break the system. Mm-hmm. I think historically, and this gets back to a point that Eric made earlier about like you'd have to have some pain. No one gets mad about that until the system breaks, right? Like no one was sitting around in 2000. Well, Greg Mankiw was sitting around in 2005 saying that we should do something about the housing bubble. But in general, most people were not saying like we should crack down on, lending practices kind of thing until things broke.
Eric, you talked toward the beginning about the taco trade. That part of why we're not seeing this flow through as much as we might expect in financial markets is that the threats are not taken seriously. Do you see that at the firm level also, or is there a disconnect here? I mean, that you might buy a stock and say, I don't care about what Trump threatened. If you are, an executive at a publicly traded company, are they making the same business investment decisions they would make? These threats were not there.
Yeah, I think that's exactly the right question. I've been most guilty of it. I've said investors a few times. I have a clue what I'm talking about because the investment calculus of the markets and corporate leadership is, I think, very different with regard to this. I brought the taco impulse up in the context of markets because markets are looking at their long-term probabilities of the outcomes they're going to get. They have seen over the course of the year the administration back off some of its most aggressive tariff posturing in several cycles, and they've kind of learned to bet against that happening in the near term. Corporate leaders who are judged on kind of their shorter term performance and what's going to happen to their own relationship with the administration in the near term and their quarterly results value that downside risk of destabilization, I think, much more than the median investor in the US equity market. And there, I think you are starting to see a lot of this activity, a lot of conventional business investment be chilled by what's going on more broadly. And what I mean by that is right now if you just look at how much businesses have been investing in the world, it looks great, just like the stock market. But it's been very heavily concentrated, as many before us have noted, in data centers for AI this year, for software development, things that are kind of very narrowly concentrated but booming right now. If you look at kind of conventional spending on, factories and equipment and intellectual property that are, the conventional underpinnings of U.S. business investment, it's been anemic year to date. And I do think a lot of it has to do with corporate leaders say this is too wild right now for me to make a big bet. And Mark made a comment that I think is generally right about businesses like when there's a business-friendly regulatory regime. What I think is important about this conversation is a lot of the administration's moves are happening with a veneer of business friendliness, but they're actually withdrawing the things that corporate leaders rely on to make confident investments, like a belief in the long-term reliability of the courts to adjudicate disputes in a fair way, a belief that an independent Federal Reserve will keep inflation from getting out of control by the time you realize your profits. All of those things are making the job of the corporate investor harder to do.
I want to open up to the audience in a moment, but I want to ask one last question on the tariffs, which we actually have discussed less than I sort of expected. The moves that the president has made on tariffs are unprecedented in a number of ways, but are like in several different dimensions. I mean, the tariffs under IEEPA might well be illegal, as the Supreme Court is considering. You have other tariff powers that he has just chosen to use in a much more expansive way than prior presidents have, but are not different in kind from that. How should we think about the tariff system as an institution? To what extent is it breaking, and in which ways?
So before I answer that, I actually wanted to comment on the taco trade. So this is perfect.
Yeah.
Which is that I've been a little bit frustrated by the taco trade when it comes to tariffs in particular, because, for instance, you saw this after Liberation Day where they announced tariffs, the market panicked. Then they announced that they were changing tariffs. There's this like dramatic story about like Besant and Hassett like running into the Oval Office. It was very, very soap opera.
Yeah, they literally had to trick Peter Navarro into
Right.
being in a meeting on the other side of the West Wing.
Exactly.
Yeah.
It was like something that only happens in a TV show.
Yes.
I have a friend at a hedge fund who literally spent a couple days trying to dispatch his interns to the Lafayette Park to try to identify which individuals were moving across. I don't think it worked, but there was a significant investment that
I
was made.
love that. But like if you look at, for instance, what the effective tariff rate was after they retreated after Liberation Day, it actually didn't come down that much. And I think there was just kind of a, I guess, decision by people that this was a backing off, even though it wasn't that much of a backing off. If you look at the effective tariff rate right now, it is still really quite high. And it is much higher than I think many of us would have thought you could put in place without investors, meaning markets, freaking out. And so I think there's been a little bit of, I think Trump has chickened out less than sometimes people act like he has. Like we are still facing very extensive tariffs. On the question of like, is the tariff infrastructure working? No. I mean, it is kind of insane, right? That you can get into this situation where, Trump has imposed, according to, I believe I'm legally supposed to say, according to Budget Lab estimates, a cost of about $2,000 per household without Congress voting on that, without there being any sort of process around that, with it just being like, oh, this is what the taxes that I am imposing now. And, this is partly literally what the revolution was about.
Well, obviously it's not working. What I'm trying to get at is the extent to which this is like Trump breaking the law versus the law saying something that it probably shouldn't say.
Yeah, I mean, I would be interested in the law professor.
Yeah.
The IEEPA stuff does seem to me quite an interpretation. But many of the other tariff powers, it seems like he's within his rights.
Yeah, I agree about the assessment of IEEPA. I do think that the law is being distorted and misused, and the fact that it's never been used this way before is suggestive of that. But it's also the case that one of the big lessons of both the first Trump administration and the second are that there are lots of authorities that Congress has given to the president over the years, over the last 200 years, that if not used in a spirit of forbearance and with the interest in maintaining a stable democracy, can be disastrous. And so this is why, for me, one of the greatest threats of the current moment is Congress's failure to stand up to any of this. And it could, but it hasn't. And that's obvious why, because it's controlled by a Republican Party whose leader is doing all of this. And so people said this after the first Trump administration, but it's going to be no less true, even more true after this one. There are many, many laws of this sort that need reconsideration because it's a way that they can be used by a president who is primarily interested in personal gain as opposed to whatever our conception is of public interest.
Do we have questions? Yes, over here.
Yeah, I have a question just picking up on the personal gain and also the AI bubble. Assuming that the bubble burst kind of a la what happened in 2000, it's not a financial crisis, but a AI crypto valuation crisis. What prevents the administration from picking winners, doing selective bailouts. I mean, there's already been talk of OpenAI getting a $1.4 trillion guarantee. How much can the administration do that to kind of prop the stock market and selected stocks up without using Congress?
Yeah, I'll comment on the market risk, but would defer on the where the legal safeguards are there, which I think is the crux of your question. I think that very question is part of the reason that AI valuations are as inflated as they are today, because there is a market confidence that the bar for what would constitute a bursting of this particular bubble is much higher than normal, because the administration will deploy kind of winner picking logic with more gusto than is historically the norm. But I join your question on if there are reasonable legal safeguards against that, which is something I'm worried about.
Yeah, I think there might be resource-oriented safeguards, right? I don't know that there are either statutory authorities or pockets of resources that would enable that kind of selective bailing out without Congress's participation. I mean, I think Congress's participation will be essential. The question, though, is what is the alignment if and when this happens, and can the president manipulate Congress into doing precisely what he would do but lacks the authority to do?
I actually have a question on that for both of you, which is that presumably if he tried to stretch any sort of executive powers to be able to do some sort of rescue in a way that had not been attempted before, I mean, I realize that you can't really answer this because like someone would sue, right? And you're like, well, under what law and what stand? But like presumably the market wouldn't get the full benefit of it because it would be drawn out in litigation, or is that not the right way?
I think it would be I mean, it would depend on how the Supreme Court responded and how quickly it responded and what it did. But yes, it would be a drawn out process.
Yes.
Yeah, can I just have a clarifying question on this bailout issue? What about the Exchange Stabilization Fund? That's basically with the authority of the Secretary of the Treasury.
Yeah.
Could that be used?
Yeah, I mean so they're probably, I mean, maybe you probably know what this fund is. I don't know what the fund is. There are authorities like that an administration would turn to see if they could be applied.
Well, this is what they've been using for Argentina.
Yes, yeah, what they use for Argentina, it's, it like, there's an analogy to IEPA, it has fuzzy boundaries, and any Treasury Secretary, including, by the way, the Treasury Secretary I worked for, who, worked for the other guys, we would often, that was a place we could go when a creative solution was necessary, right? I don't have an edge on like how that legal battle would shake out as it applies to the ESF, but that's where the analytical question will be. And it's, I think probably less, well, I got a P and admin, I'll defer to you, but it's less, my sense as the like realist standing from afar is it's less about the, statutory analytics and more about where the broader political posture is on how tough the court wants to be in constraining his power.
Well, it's also a question of scale too, right? If the scale of any collapse is commensurate with whatever authority funds exist in that fund, and I mean, you would know better, but it sounds like what could potentially happen is quite severe, and so maybe the existing.
Yeah, I mean, it's complicated. It's severe relative to where things are right now, but even a historic once in a century stock market crash would, it would only bring us back to where we were at the start of the year in terms of the wealth. It would be very, very painful. But a stock market reduction from here of a given percentage would be less painful in terms of the real economy than I think normal, not to minimize the fireworks that would happen if we went down this path. But I think the disconnect between, real economic health of the median household and the level of the S&P 500 is a little larger than normal now.
I do just want to say, because we are currently speaking in this room to largely Yale and YLS students, but there are people who are watching online who are not Yale and YLS students. When he says that he got a P in admin, he means that he like passed the class.
Yeah.
Just to like speak to the whole, to everyone.
I'm still upset about it.
Yes.
I was just curious about sort of distinguishing between the general deregulatory push that y'all have mentioned and actual undemocratic deregulatory impulses. Like I worked at the CFPB before law school, And I was there at the tail end of the Trump administration and through the first part of the Biden administration. And the first Trump administration treated the agency far more differently. Like there were selective reductions in force. They did repeal certain regulations, which was expected and I think, considered normal. But now you're looking at a situation where, they're trying to riff like 1,300 people out of the agency. They're like going after sort of any ability for the agency to function given its statutory mandates. So I'm just curious, is there a difference between deregulation and undemocratic deregulation? Is one more damaging on the economy?
So I do want to say on the deregulation front, this isn't answering your question, but I do think it's important. I have actually seen less actual deregulation than non-enforcement of regulations. And I do think that's an important distinction, right? Because for like proponents of deregulation to get the like long-term benefits that they say come from that, and in many ways you need long-term promise. It's like not that helpful if you say, like right now, we're definitely not enforcing this law that you think is holding back business, and business leaders are thinking like, okay, but if, X person who we hate is back in 4 years and is gonna start like enforcing the law for what we did over this time frame, and you haven't changed the regulatory environment, that's not as helpful. And so was not your question, I will leave them to answer the question, but I do think it's an important distinction.
I do think non-enforcement is the first step towards deregulation and can be done quickly, which is why the enforcement power is a significant power for the president, the executive branch. And the question is, how many regulations are they seeking to rescind, right? And that takes a lot more time under administrative law. It requires that you follow the same process that you use to adopt the regulation, assuming they will follow administrative law. So that is an unknown, but a lot of those things are on the chopping block. The question about the CFPB, the way I would think about it is this, that head of OMB is clearly trying to shut it down, right? And that's different from trimming its sails. And so I don't know what effect that's going to have on the economy, but on some level, even though that's the question of this panel, that question is irrelevant to assessing what's happening. And so there can be a disconnect between anti-democratic actions and actions that affect the economy. And there can be things that, and this is how I think you can have authoritarian regimes where economies thrive, because they're not necessarily integrated. And so it may be that destroying all these protections for consumers is actually really bad for consumers and then therefore bad for markets. I would defer to economists on that question, but there's a separate issue of whether what's happening now is different in kind than what happened the first time around. And I really think it is, because it is an affront to the separation of powers in a very deep way.
Is the selective enforcement choices that we've seen this administration make, does that have lessons for us for the long run about how some of these powers should be structured? I'm thinking particularly about antitrust, where that's one, the administration, especially in the media space, but also in some others, has been really, for reasons that clearly are not directly related to promoting competition, been using that power to exert control over the corporate sector. On the other hand, there's no way to do antitrust enforcement that doesn't involve a significant amount of discretion on the part of the executive. And so is it just a matter of like electing presidents who will be responsible here? Because that's not a very satisfying answer. Is there anything?
It's just sometimes that is what it boils down to, is
Right.
having people of character and commitment running the show. I don't think you can eliminate discretion from law enforcement. It's baked into the role in a world of limited resources. And I think that most people would agree that a new administration gets to set priorities about how to enforce. I think Congress does have authority to limit that power by saying you must prosecute these kinds of cases over and above these other kinds of cases, and so you can try to introduce those kinds of legislative restraints. I think it can be risky to do that though, because the discretion of the prosecutor is one that is essential to allowing the law to function and not become overbroad or oppressive at the same time as it can be used to make the law irrelevant. And so it's a tricky balance to strike.
Do either of you have any creative ideas in that space?
I don't, but I do think this kind of raises a broader question, which this panel has sort of danced around, which is, I think people like to say kind of, democracy is better for the economy. That's not entirely correct. What you do have is that under autocracy, you get a much wider standard deviation. And so you have autocracies that, per Christina's point, like are good for the economy, and then you have autocracies that are very, very bad. And that is because you are reliant on the whims of one person. And so if you have one person who's like totally devoted to central bank independence, isn't doing tariffs, like is thinking really carefully about antitrust, all these, like you end up with like an economy that does pretty well. If you have, an autocrat who's engaging in a lot of self-dealing and is willing to, undermine inflation expectations for short-run lower interest rates, we can all name things here, then it goes quite badly. And so I do think we shouldn't, it is important to acknowledge that part of what you're getting with an autocracy is a much wider range of outcomes, as opposed to democracies, which tend to be really.
Yes.
You focused a lot on the Fed's role in setting interest rates. You've alluded to some other areas of risk. Can you maybe say more about any other functions or institutions where cronyism, partisanship, or even just sloppiness could present a really irreparable harm? Thinking the Fed's also a major regulator of banks. Fannie and Freddie's regulator and conservator has kind of made some interesting remarks that the market has been unsure about. Just curious if there's any others on your radar that keep you up at night.
I mean, the other obvious one that Martha hit on quickly, which we're feeling in many different ways right now, is economic data. And well, actually, I generalize it beyond just economic data, but the role of the civil service in making observations about what's going on in the world. And the one I care about most is the production of economic statistics that I follow every day, right? And it's been many have remarked that a loss of confidence in economic data production has historically tended to lead, collapse of democratic norms that seem much more important than that. And now, we're in a moment where we don't have a lot of economic data, not directly because the administration said don't turn it off, but has said turn it off. But the shutdown has given us a little bit of a natural experiment in terms of how there are different competing narratives about basic answerable facts of what's going on with inflation right now that we don't otherwise have answers to. And in the absence of data that everybody has confidence in, that the winner of that debate becomes the winner of the political narrative rather than some objective source of truth. I've been dealing, as an investor in China, I've been dealing with this my whole career, thinking about the extent to which we can believe or not believe the official statistics coming out of China. I'm very used to thinking about that outside the developed world. And now some of those same investment modalities that were applied to China 20 years ago are coming up in conversation around trying to figure out what growth is really. And that's different.
How are you seeing how the markets are managing that now? I mean, is there, the weaker signal, is that what does that cause to have a different price?
Yeah, I do think as long as this shutdown has been historically, we're not right now in such a prolonged data fog that it's showing up anywhere. I think if we got a very politically oriented commissioner of labor statistics, then we're in a world where trust in that data over the course of years starts to erode. And that's when I think start to mess up. So I wouldn't identify a price that's different now because of the shutdown. But what I would point to is there's a lot more argument about facts that should be answerable in the market debate today. And if that argument were to go on 6 to 9 months, then yeah, I think that would be a new source of risk premium in US equities because we don't know what the inflation picture is going to be. But we're not there yet.
I do think it's going to be interesting when the Federal Reserve makes its decision in December, how much they kind of say that they were hampered in trying to figure out what's going on and what the right decision was by the lack of data. Which gets back a little bit to your question, which is, I think part of the reason why you hear us talking so much about the Federal Reserve is, at least for me, there are plenty of things that I worry about. If the Federal Reserve can do its job, and I include access to good data in the Federal Reserve being able to do its job, there are a lot of other things from an economic perspective that I worry about less, because the Federal Reserve is a bazooka, and it can, there's things on inflation expectations, on inflationary pressures, but I do think that the Federal Reserve can bring those under control. There's just a lot that because of the power of the Fed, that just makes a huge, huge difference. And so to me, it sort of trumps, no pun intended, any of the other things that we're talking
Yeah, just one overarching thing, which is that I think that one of the elements of the assault on the rule of law is the assault on the civil service, the assault on expertise, the assault on data, and both the lack of interest in it to drive decision making, but also the manipulation of it to serve political ends, and that has administrative law dimensions to it, has constitutional dimensions to it, but it is essential to a functioning system, not just with respect to economic regulation, but with respect to health and a whole range of issues. And so that is also a kind of existential challenge to our system of government, including democracy.
Well, on that light note, we're out of time. I want to thank all the panelists for joining us today and thank all of you for coming.